Assalamu alaikum. I'm Ali Mohammad Shafi. My roll number is 23110371227. Today we will be discussing about the basic Excel's formulas used in financial calculations. So today we will be discussing about the effective annual rate, bond value, capital budgeting, IRR, loan amortization, and loan amortization date. So our first topic is IRR. Sorry, EAR. So our first topic is EAR. That means effective annual rate. So effective annual rate means the effective, how the annual rate will be effective. That means it indicates the future rate that will affect uh, in our company or business or some project. So it is effective in future. So that's why we will have to write the formula as equal FV. We have to, when we are asked to find the EAR in Excel, we have to write the equal FV to find the effective annual rate. We have typed FV, then we have click on tab. So here we can see we have to give the rate. From the given data, the rate is 12% and is in B3. So we have selected the rate, comma, N. Oh, sorry, there is M. So I have already discussed in my previous video. We have to divide the rate by M. So we will B3 divide V5, comma, and we have to multiply N with the M, means B4 in multiplied with B5, comma, PMT. Here PMT is 0, comma, PV. PV is given here, comma, type 0. So remember one thing. After we write all the every formula in Excel, we have to write -1 for effective annual rate. This is the formula of effective annual rate. It is similar to AV's formula, just a difference that we have to add the -1 to calculate the effective annual rate. Then we will press enter. This is not in the version of percentage. We will make this amount in percentage. To make it percent, we will go to the ribbon and home. Then we will make it to percentage. This is the percentage of EAR. That means the effective annual rate is 12.68%. Our next topic is bond value. To find bond values, we have to uh, we have to uh, uh, write this formula. We are finding or calculating the present value of bond. That's why we will write equal PV tab rate. There is two rate is given. We will select the year to maturity, comma, years to maturity, comma. That means N per, comma. So here is the difference. When we are asked to apply or when we are asked to calculate the PMT, we will just simply multiply par value with the coupon interest rate. This is our PMT, comma, FV is par value, comma, type is 0. So this is the formula to calculate the present value of bond using Excel. Then we will click on enter. So this is the uh, present value of bond, 1149.39. So next topic is um, the capital budgeting. So here we can see cash inflows, cash outflows, net cash flows, and cumulative cash flows are given. Here we can see the cumulative cash flows are given. We have to calculate this thing. So we will just equal. There is a simple mistake. We will do. No, there is a mistake. Wait. 51, 30, 56. So here is the amount we are looking for. So in this box, we have to find the net present value. Six plus. But to find the NPV means net present value. So the net present values formula is equal NPV. We have to add the rate. This is the rate, discount rate, comma. We have to select the net cash flows one value one to rest of the values. We will not select this initial investment. This is the initial investment. Then we will close the bracket and plus the initial investment. This is the formula of net present value. So this is the cash inflows uh, which uh, which came into the company, and this is the cash outflow, which is investment and the expenses of the company. Then we have the net cash flows. Net cash flows came from the difference between the net inflow by and net cash outflow. Is the difference between the net cash inflow and the net cash outflow. After the cash flow, we have the cumulative cash flow. This is the we have minus the cumulative. We have the minuses the cumulative cash flow from the net cash flow. So after this writing this formula, we will click enter. So this is the net present value of this project 2. Similarly, if we want to find the IRR using Excel, we will just write this formula equal IRR tab values. These values includes the initial from the rest of the net cash flows of the company and comma guess zero. So bracket close, enter. The IRR for the project 2 is 11.34%. Now we will have we will have to calculate the payback period. The payback period does not have any formula for this. We will just have to see in which year we have the payback. We have the initial investment payback to our company. We can see in third year we have minus 57,500, and in fourth year we have plus 18,500. That means the payback period is between these 2 years. So for the fraction we have to write this equal 3 plus ABS. The ABS means the fraction, and we have to divide this amount by this amount to get the payback we get. So we click on enter. After clicking enter, we can get 3.76 years. That means the payback period for this project is 3.76 years. After 3.76 years, we will pay back our initial investment. So this is all for from capital budgeting. So our next topic is IRR. We will have to calculate these two projects, IRR, XRR, and MIRR. So for calculation of IRR, we have seen previously IRR values for project A values will be from initial to rest, comma, gets equals to 0. So the IRR is 19.86, and the for project B equal IRR values, rest of the values, comma, 0, bracket close, equal 21.65. So choice of project A will be project B, because the IRR percentage is higher in project B. Project B have the higher percentage of um, internal rate of return. So we will choose the project B. So for determining XIRR using Excel, we have to write equal XIRR, comma, XIRR tab values of project A, comma, dates of project A, comma, day 0. So this is the XIRR. So this is the XIRR for, oh shit, I have chosen the, a little mistake where was occurred by me. XIRR, the whole thing is selected, you including a IRR. So whenever I just click on CTRL shift and down arrow, the IRR was also selected. That's why the XIRR was not calculated by using Excel. So the guess is 0, bracket close, enter. XIRR is 22.05%. Like the previous one, we will write this one also, XIRR values, comma, date, comma, 0. So the, oh, I have chosen the wrong values. That's why the XIRR percentage are both same. So the project B's XIRR is 26.43 and project A's is 22.05 MIRR. To calculate the MIRR, we will simply write the MIRR in Excel, then values, Then financial rate and reinvestment rate. In this data, there is no, there is not given any financial rate or reinvestment rate. So the capital cost of capital rate will be our financial and reinvestment rate both. So after choosing this, we will click on enter to get the MIRR. Similarly, MIRR values, comma, debt, comma, financial rate, reinvestment rate, comma, financial rate, reinvestment. Oh, sorry, there is no date. So the MIRR for project B is 16.04. So our next topic is the loan amortization table. So we have this particular data. That means principal amount is 500 lakhs. So a zero balance for is 500 lakhs. 500 lakhs. Okay. So we have to calculate the payment. We have to calculate the payment, interest, principal, and balance for the year. So for payment, we have to write this formula equal EMT cap. Rate is 12% by payment per year, comma, N per. So here payment per year is the M into 12, comma, PV is present value. That means 500,000, comma, there is no FV, type 0, bracket close, equal. So this is the payment for this first year. We simply have to, we will simply have to uh, uh, preach all these data cells of Excel. Then we will drag this down to 180 CTRL-D to get all the cells filled. Our next is we have to calculate the interest. For interest equal IPMT. This is the formula of interest rate by M, comma, par. Par means month one. This is the one and only variable for this formula, and all other this are will be constant for every interest calculation. N per means so year into payment per year, comma, PV will be this and FB will be 0, type will be 0, and we will press the enter simply. This is our first year or first month interest. We will have to give F4, F4, F4. That means we have reached all the cells. Now we will have to drag it down to 180, and we will just simply press the control D to fill all the cells of interest. For principal, we have to type equal PPMT. That means principal of PMT, interest of PMT. IPMT means interest of PMT. PPMT means principal PMT rate by M. Par means 1, NR into 12, PV, FV not 0. We have the principal for the first month. Now we will freeze all the cells except H9. That means this is the variable it can change. So we will drag it to the down 180 months, all 180 months. We will have to select the control plus D to fill all the cells. Now it is time of to balance. So for balance, we will just simply press. We will just the balance is the difference between the the principal and the balance. So we will write this formula equal balance minus. It is all already in the minus format. We'll close the bracket. So the balance will be this. So we have to fill this balance to the to 180 months. CTRLD. This is the whole balance. The balance will be 0 after 180 months. So this is all for today. We learned how to calculate EAR, present value of bond, how to make the capital budgeting, IRR, and choice of projects, and loan amortization using Excel. So thank you everyone for your attention.